All right, folks, back here, part 4 from chapter 2. Anyway, let's take a look here. Get my pen started up here. All right, so remember, Noodle Cake had borrowed $20,000 from the bank. Okay, right. So notice first you analyze the assets increased by 20, right, and then we have our note payable long term increased by 20. It's a liability. So the journal entry, we got cash. That's the debit. It's increasing. It's an asset increasing. There's our debit of 20. Remember, you indent for your credit, right? Note payable long term, 20,000. That's increasing. By the way, note, it says here, signing a formal agreement. That's what makes it a note, okay? So note payable, something you owe, and you signed a formal agreement. By the way, if you take a look, cash is increasing by $20,000. And notice over here, it's an asset, so it increases with a debit. Note payable long term, it's a liability. That increases with the credit. So remember, debit and credit, all it means, debit means left, credit means right. It doesn't mean increase or decrease until you know what type of account it is. See, look, cash is an asset. It increases with the debit. Note payable is a liability. It increases with the credit. So you see, all debit and credit mean is left and right. You know, a lot of students, they're like, well, my debit card, my credit card. Forget that. That's not accounting, okay? All right. According to Dr. Cohen, undercounting accounting terminology is not necessary, very necessary, cannot be accomplished, is required for 2280 only. Anyway, this is question number 6 from chapter 2. Don't forget to write these down so you can take your quiz, okay? All right, next, we're going to buy some equipment. Remember that equipment we bought? $9,600, right? And we're going to pay them at the end of the month. That's what we said. So our equipment's increasing. That's an asset. Liabilities are increasing. That's a liability, right? Accounts payable is increasing. It's a liability. So here you go. Equipment's an asset. Increases with a debit. There's your debit. Now we have to indent for our credit, right? Accounts payable, because we're going to pay them at the end of the month. No formal written document. 9,600. That increases. It's a liability, increases with the credit. So here you go. There's your credit. Accounts payable is a liability, so that's increasing on this side. Equipment is an asset. Assets increase with the debit. And so notice, that's increasing on that side. Okay? Not too hard. Now we're going to pay that supplier. Well, it looks like we're only partially paying them. So we bought that equipment. But now what's going to happen when we're going to give up some cash and we're going to lower what we owe. So notice what we're doing. We're going to debit the account payable. We're going to debit that liability. Right, look what happens. Here's our liability, that account payable. When we debit it, debiting that lowers it, right? So now we only owe $4,600. And look what happens to our cash. Our cash, we're going to credit it, right? We credit it to lower it. There it is right there. See how it's on the credit side? So again, you indent here, and there you go. So again, what are you trying to do to the account? You're trying to increase it or decrease it. If it's an asset, you increase it on the debit side, and you decrease it on the credit. If it's any kind of payable, if it's a liability, that increases on the credit side and decreases on the debit side. So it really matters, debit and credit, only left and right until you know what type of account. Okay? So in this case, this was the one where nothing has happened because they signed a contract, but they signed a contract that they're going to do it, but they didn't receive anything and they didn't pay anything. So they only exchanged promises. They didn't exchange any merchandise. They didn't exchange any money, nothing like that. Okay? Now they finally received that software, and what they're going to do here, $9,000 for an app gain code ordered, pays $4,000 in cash, and they're going to pay the $5,000 next month. So what happens is they got one asset's going to go down, one asset's going to go up, and their accounts payable is going to go up. So notice the software, that's the asset they got, $9,000. That's right there, that's the increase. Now cash, that's the asset that went down. There's your $4,000, and there's your account payable, the liability. So notice, here you go, account payable, liability, increases on this credit side. Software, that's an asset. increases over here on the debit side. Okay, and then cash, we lower it. Cash is an asset, and we're lowering it, so it's on the credit side by $4,000. And notice how this balances. This has to balance. The debits must equal the credits. It's called balancing your transactions. They have to balance. 9,000 debit, 9,000 credit. Now we're going to get supplies on account. Supplies are an asset, increasing, and we're going to pay them later. Notice, on account means they're going to pay them at the end of the month. $600. There's your supplies increasing, asset, account payable, liability increasing. So there you go. Increases over here, $600. Over here it's supplies, debits increasing. Okay. By the way, so here, these are all the T accounts for Noodle Cake. Now what they do is they take all of these accounts, and that's what they use to make up a trial balance, right? So that they want to do, they want to see to all of our assets equal our liabilities and stockholders' equity. So they're going to take all of these totals. See this total, this total, this total, this total, this total. That has to equal the total of these items. Okay? And so what they do, notice they took them all. They took all the totals from those items. You can go and look. These are all the totals here, and they go $40,200. And then they add up all the credits, and it's $40,200. So now we know debits equal credits. And again, notice it says trial balance here. It says it's at a point in time. Point in time. Okay. Now, to let you know, what this shows is that debits equal credits, which is good. Debits equal credits. But we don't know for sure that all the journal entries are correct. We know they're on the right side. But so, for example, somebody might have put this account payable in with notes payable. Let's say instead of this said 30,200. Okay. They put these accounts payable in with the notes. So notice we would still balance, but that don't mean they're necessarily the right accounts. It's a great starting place because it tells you everything balances. But that's all it tells you. Okay? All right. Why is a trial balance helpful? Okay? So again, I don't know what question this is. I think it must be, let's see, what was the other question here? Let me go back. Where's my last question? 6. This is question 7. Question 7. Forgot to put the 7 in there. Question 7. Here, we'll put it in there right now. Question 7. So make sure that you write down your answer so you can put it in on Canvas. So here, this is a classified balance sheet. Notice the name of the company at top, name of the item, in this case, balance sheet. It's at a specific day. It's a point in time, right? So the assets, what they're doing now, it's classified. What they do is they're using current assets, and then they're using total assets. So they're saying cash and supplies, these are current assets. And why? Because they're used in less than a year. All they're doing is making subtotals. So here's the first subtotal. Here's all the other assets. So they still equal 40,200. Then notice in their liabilities, they give you current liabilities. And then normally they would give you long-term, but they don't say long-term here. But notice total current liabilities. So all they're doing now is putting a little more definition in here. A little more definition. Okay. Notice we don't have any retained earnings yet. Okay. Because we haven't made any money yet. We're just starting. Okay. All right, last item we're going to take a look at here is something called the current ratio. Okay, the current ratio. Now, here we're going to interpret what the balance sheet says, right? So basically, this is a finance type thing. So the folks in finance, what they do is they take the work that we do, and they have certain ratios that tell you, is this a strong business? Is it not a strong business? How are they doing? So let's take a look at how this is done, okay? So this has to do with assessing ability to pay. They're looking, do they have more assets So do you have more assets than liabilities? In other words, do you own more than you owe? Okay. Now, by the way, it's that kind of makes sense, right? You better not owe more than you have. So here, our current assets are 21,300. Our current liabilities are 10,200. So notice it's 209. What it means is basically that for every dollar we owe, we have current assets worth about $2.09. So notice we have basically a little bit over a 2-to-1 ratio, right? Which is good. Imagine if that was flipped. Imagine the numbers were this: 10,200. Let's say those were the assets, and your liabilities were 21,300. Now, if you were a bank and you say, wait a minute, this is all the money you have, and this is how much you owe, ooh, that looks a little dangerous. So what this does is it helps you see how strong a business is. What's their ability to pay back? Okay. So notice what's happening here. There's a lot of things in here, but there are some activities that that are not on the balance sheet. A lot of times, one of the things, for example, they say, people are a valuable asset to us. Well, you'll notice there's nothing for people on here. Okay. All right, folks, that's it for part 4. We'll be back to do some of these exercises in just a minute.